battling the relentlessly negative doom and gloom news media. It's the Nick Stenger Show, coming to you live from the Stenger Family Office headquarters. It's your host, Nick Stenger.
Ladies and gentlemen, welcome to the Nick Stenger Show. My name is Nick Stenger. We are the Stenger Family Office. For the past 42 long years, it has been our mission to deliver both clarity and confidence to help secure your financial future. Welcome back to the weekly show. This is, in fact, the weekly show. So don't let not your heart be troubled. We don't have the usual podcast room setup. Ran out of time this week to get the usual setup all ready to go. So just recording live from my Naperville office. And we are going to talk, it's episode 123, about the U.S. debt downgrade with the Treasury. And we have entitled this week's article, U.S. Downgrade Not Surprising. So this may come as a surprise to some people who are unaware of what has been going on the past couple years with the COVID crisis and all the print and spend philosophy from the Federal Reserve and everything else that's been going on at a political level with fiscal policy. But for people who have been following this thing, it really shouldn't be a surprise. And the reason why is that at some point when you spend a boatload of money, you are going to have to pay that bill off. There's no way around it. We wrote the article, The Bill is Due, and that was a little play on what's going on with credit card debt. And if you have a bunch of money, a bunch of debt on your credit card, you maybe had a great time, you enjoyed spending the money, and you seemed like you were doing really well before you had to pay that debt off. Well, we all know eventually that bill comes due, and that's what's happened with the U.S. government today. Yes, it's a little bit of a shock. The Fitch downgraded the U.S. Treasury debt last week, and obviously market's off about 3% from its 4,600 level is where it got off up to on the S&P 500. But again, this really shouldn't be a shock. We have printed 40% more dollars into the economy the past 3 years under COVID. Again, some of it you could argue was justified. I've said a lot of it wasn't. A lot of it was a complete debacle. It should have never been spent. But reality is we have to deal with this now. We have to invest in light of the increased debt load. Our debt to GDP ratio today is 128%, which does not put us at the Japanese levels yet. But I believe we are headed in that direction if we don't change course and change quickly. And so again, this is not an immediate reason to panic and sell and run for the hills and build a bunker in your backyard, filling it with food and gold. I know that's tempting to do. I sympathize with that idea, but please don't do that. Please don't sell your stocks, because we saw this same thing happen in 2011. The last time U.S. debt was downgraded, there was a short-term panic and a pullback. The market fell about 15% from its all-time high in 2011, and I think we could experience something like that today. It's possible that we retest the 4,100 point zone on the S&P. Right now, remember, it's about 4,500 points. We could fall backwards to 4,100 temporarily, which would be roughly a 10% decline. That would not be out of the ordinary. In fact, I do think we are due for an intra-year decline. That's not a reason to panic. Even in the best of years in the stock market, you think about 2016, 2017, 2019, 2020, 2021, 2023 now. Even in these record face ripper double-digit years where we do double or even triple what we're supposed to do. Remember, we're usually supposed to get about 7% return. In some of those years I mentioned, we've gotten 3 times that much, 4 times that much. Don't be alarmed if during those years you give a little bit back temporarily. Since 2011, since that last U.S. downgrade, stocks are now up 233%. But my warning is in my message on today's show, episode 123, is that the Fed and politicians just need to be aware they should treat this as sort of a canary in the coal mine. It's not this all-out abyss or anything like that. But what they should do is this should serve as a warning, just like you would get from your credit card company. Hey, your bill is past due. Your bill is due. This should serve as a warning to the U.S. federal government that their credit score, so to speak, has gone down. It's not to say it can't ever go back up, that it can't improve, but there needs to be some sort of check against reality. It turns out that if you spend money into oblivion and you don't collect enough tax revenue to pay for the money you spend, you end up having to take on more debt. And the biggest problem now, which we'll talk about a little bit more in 1 second, is the fact that that debt is now being financed at higher interest rates than the government really can support. And during COVID, what we really should have done is we should have locked in our debt like Mexico did by issuing 100-year bonds or 50-year bonds at 0% interest rates. That would have been the wise thing to do. We really didn't do a whole lot of that. And now the federal government is paying almost $1 trillion per year in interest on the debt, risk-free to banks, which is why I've always said banking and business and big government all hand in hand. They all work together. The big banks set up the Fed in the beginning. It's one of the 10 tenets of Marxism. It's one of the planks. And the reason is banks love money printing, because when you print money, it's basically like creating your own demand. It'd be like Apple coming out and they force a law with the federal government that everybody's got to have an iPhone. It's the exact same concept. Banks love increased money supply. So here's the reality. Today in the United States, we do not have a wealth creation problem. And that's the good news. The good news is that we as a country, our entrepreneurs, our business people, our workforce, you and I, create an incredible amount of wealth to the tune of $27 trillion per year. That's our annual GDP, gross domestic product, that we produce. And so that is such a phenomenal number, puts us at the number one economy still in the world, despite all those doom and gloom predictions that China would take over as number one. It just hasn't come true. And people said they've got 1 billion people. It's just inevitable. They're going to take over. And that just hasn't happened. The U.S., you and I, are the most productive people on earth, producing about a quarter of the world's wealth with only 4% of the world's population. And the Chinese barely produce 18% of the world's wealth, but they have a much, much larger share of the world's population. And so because of this, that is a reason to stay optimistic. You should be feeling good about the fact that we create a lot of wealth. It'd be like if you had a corporation and you had a lot of debt, you had a big debt load to pay off. Well, we always want to check debt against assets and then income. Can we afford to pay the debt? Because let's just go back to the credit card example for a second. Let's just say there's a family and they've got $100,000 in credit card debt. And you hear that and you go, that's just terrible. How are they ever going to get out of that hole? Well, it's all based on, it's all relative, because maybe that family makes only $100,000 a year. Well, it's going to be really tough if you only make $100,000 to get out of $100,000 in credit card debt. If you make $1 million per year, getting out of $100,000 is relatively easy if you have a plan in place. And that's where the U.S. is today. We have a ton of income, a ton of wealth. We could easily put a plan in place to pay off our debt. It's just going to come down to, do the politicians want to do this? The problem we have, more pressing problem we have, is the fact that tax receipts, the money that the government collects in tax revenue, is only $4.9 trillion. Federal spending is $6.27 trillion. And that's why the deficit goes up. That's why we keep adding money to the federal deficit, is because we simply spend too much, or some people would say we don't tax enough. Either way, whatever you believe, there's only two ways to close the gap. Number one, you either got to spend less or you got to make more. You got to increase your taxes. And I think one of the problems is to all the people out there that think it's as simple as just taxing the rich or increasing the taxes on corporations. And you've heard this line that companies don't pay their fair share. They just don't have any sense of history. They just don't have any sense of perspective that would show them that every time you increase taxes, anytime you mess with incentive structures, what ultimately occurs is if you tax something, you get less of it. And so we do not want less tax revenue. We want more. And so the question is, how do you get more over time? Is it you just raise taxes on the middle class, because that's the bulk of the wealth in our country, the upper middle class, and people that make $100,000 to $400,000 or $500,000 a year, that window pays a lot of tax relative to their income. So can you really afford to tax them more? That's a big question. Or does that ultimately hurt them? I would argue it hurts them. I don't think that's a good idea. So then it pivots to, okay, maybe we can tax corporations. Maybe we can even do a wealth tax. That's been one of the proposals from one of the senators from Massachusetts. So all of these ideas, when you look at them, still don't really cover the deficit. They still don't even cover the gap. And so if you look at the billionaire population in the United States, it's just under 5 billion. It's 4.48 billion. And we're not talking income that you can actually quantify. We're talking wealth, which again, remember, is not just cash in the bank. It's not just real estate. It's stocks, it's bonds, it's value in private companies. It's all this wealth. If you add up all the billionaires, it's 4.48 billion. So let's just assume for a second that somehow mechanically you could figure this out and tax them all 10% per year on just their wealth alone, not even income. It still only generates 448 billion. Okay, that's 10% of the 4 point, and I might have said billion before on accident, but it's really $4.84 trillion. Still, a 10% annual wealth tax is $448 billion. You don't even get close to covering that gap in tax revenue. The other problem you'd have to have is at some point when assets go down, we know all about the good years when assets go up, stocks go up, for example. But what about the times when things go down? What if the value of Amazon stock goes down instead of up? Well, now do you have to give Jeff Bezos a credit, for example? Or what about Tesla with Elon Musk? So there's all these things that just wouldn't even make sense operationally, let alone cover the tax gap. Second of all, here is the other problem, is if you go after the middle class, which is really the only place left to go, that's what they don't tell you, that's what the politicians on both sides of the aisle don't tell you, is that it's the middle class, the people squarely in the middle of the country who pay all the tax, pay a lot of the tax, who also bear the burden of higher input costs. On average, $145,000 in annual household income. Even if you raise the taxes on them by 10%, would only generate an additional $870 billion per year in tax revenue. And so if you do the wealth tax on the billionaires, if you do a tax on the middle class, you still can't close the budget deficit. So here's what some people say. Some people say, Nick, we're not going to tax people. We love the middle class. We don't want to hurt them. We get it. We can't do a wealth tax as much as we would love to do that. We can't. So we're just going to make the corporations pay their fair share. And they go, Nick, Amazon hasn't paid any tax for years. That's just not true. And so if you actually go dig a little bit deeper, you get the data, Amazon is paying billions per year in tax, more than most companies can even dream of. Amazon, in fact, pays more money in tax than most companies make in revenue. They've got 1 million U.S.-based employees that are estimated to pay and contribute $5 billion per year in combined Medicare and Social Security taxes. Not to mention, for the first half of 2023, Amazon's already paid $1.75 billion in income tax. On top of that, They collect $1.64 billion per year in sales tax. And so Amazon is paying over $8 billion. These are conservative estimates. I would think some of the reports I've seen are upwards of $10 billion per year in tax when you really look at it and add it up, that Amazon pays every year in tax. And so this idea that the corporations aren't paying their fair share, that the companies have to step up, sure, that's fine. Maybe you feel like the tax code should be adjusted and that loopholes should be gone after. But the reality is, under current tax code, these companies are paying billions and billions in tax. The biggest tax they pay is not federal tax. It's not the corporate tax that everybody thinks of, because most of that gets passed on to shareholders, and then ultimately is also paid in payroll tax. That's where the bulk of the money goes in this country. And so one of the things we'll talk about in a second is the fact that the average employee, the average middle-class family, remember about $150,000 in income, is not paying the majority of their income in federal tax. The majority of their income goes to payroll tax, Medicare, Social Security, and that's ultimately where most of our spending from a federal budget standpoint goes, is to social programs. And so that's another thing we need to discuss. But the bottom line is corporations pay a ton in tax. The other problem is if you raise taxes on corporations, they aren't going to pay that tax. Ultimately, that corporation is just a piece of paper that passes input costs, taxes, onto consumers. Think about the profit margins on S&P 500 companies. These are the best companies in America. Well, after-tax profits are only about 10, maybe 13% in really good times, maybe 15%. So going out and taxing them more guts the value of the S&P 500. It would completely obliterate the current price of stocks, and nobody wants that. Think about all of us here in just regular America living our day-to-day lives that invest in the stock market. We've got the S&P 500 in our portfolio, for example. We've got a 401k at work. And so none of us, and it's so many people, it's not just the richest 1% that they always talk about. It's the bulk of Americans squarely in the middle who would pay the price for higher taxes. It's never going to be the corporations. It will ultimately be the people that they want to help that end up getting hurt the worst. So it's just a fantasy that you can raise taxes on corporations. The other thing that happens is if you do that, you create a very uncompetitive environment for companies to stay in the U.S., and at the margin, they leave and they go to other places. And this is why pre-2017, when the Job Cuts and Tax Act came into law, when we cut corporate tax rates, we had a flood of companies come back to the United States. Companies that had money trapped in Europe, for example, and Ireland for years, all over the place. They've started bringing that money back to the United States because the United States became tax friendly, at least tax competitive, not even the lowest taxes, but at least competitive on the global stage. So what's the globalist answer to this? What's the UN and Klaus Schwab and the World Economic Forum and the Great Reset? What's their answer to the U.S. has cut taxes? Well, we'll just have a global minimum corporate tax rate. And so anywhere these companies go, they can't escape the fact that they're going to have to pay a minimum amount of tax. Well, that doesn't work either, because all it does is it shows up in higher input costs. It shows up in higher output costs, which is the final cost paid by consumers. So any which way around it, my point is you cannot pay for the spending with increased taxes. Rather, my opinion is the politicians, and I'm talking both sides of the aisle. I have called balls and strikes. If you've watched this show for 123 episodes now, you know we do not take a political side necessarily. We like policy. We like good policy. So we like fiscal conservative policy where we cut taxes and cut regulation and we let small business thrive and individuals thrive. Wherever we can get good policy, that's where we want to go. Both political sides have been guilty of this. We saw this under the Bush Obama regulatory era of just 16 years of horrible policy, horrible tax policy, horrible regulation policy. And as a result, you've seen small business absolutely get gutted. And this is just a side note, not something that is in this week's article or this week's podcast, really, but I'll just make a note about the fact that small business has never faced more headwinds than it does now. And I'm not talking about your local restaurant, although they may have trouble. I'm not talking just about your local establishment or retailer or something like that. I'm talking about the S&P 600, the S&P 400. These are small cap companies, mid-sized companies, and you look at these income statements from the fourth quarter. You look at their 10Qs, their quarterly reports, and their profit margins, their input costs for interest rates are sometimes double what they were last year. This is a real problem. And I looked at one company in particular. I still think it's a good stock to buy, but for example, they're financing their interest costs last year, this quarter, so second quarter of 2022, was about roughly $10 million in financing costs. Now it's $25 million. That is a massive difference, and that's just not sustainable. They are going to have to lower rates, or a lot of these small businesses will go under. I think the other thing that they face is a lot of regulation trouble. So that's why in the portfolio, we have kept you in large cap blue chip stocks that are a lot less reliant on higher rates. And so these blue chip companies can go out and issue long-term paper, long-term debt at lower rates because they have higher credit ratings. They have a lot of cash on their balance sheet. So all they'll do is just slow down a little bit on expansion right now. But they're not worried about financing costs. They've got the cash on their balance sheet. So these are the things that we're watching. Again, it's just another point that the bigger government gets, the more and more it hurts the small and the middle class. That's what we're worried about. Now, let's just say the politicians could get together, the Democrats, the Republicans, they could come together and they agree to cut spending. Well, the only way that you can possibly cut spending is to shrink the size of the federal government. And this is why it never happens, is because the politicians would have to go in and essentially vote themselves out of a job. And so one of the big problems that we face with D.C., with Congress, is it really has become this big swampy mess of people basically dinosaur age, like they've been around since the dinosaurs were walking the earth, and they've been there for 50 years, and nothing's ever gotten done. They've just gotten, they've made $200,000 a year for 50 years. And somehow, I can't figure it out. I pull out my calculator here and try to do the math. Somebody making $200,000 a year, how can they possibly have $100 million net worth? It just doesn't make sense to me. And it's on both sides. You've got this with Republicans. You've got this with Democrats, where they've been around forever, and there's no term limits and there's no checks on power like there is with the president. So the only way you get something done, I think, long-term is you got to get term limits. You have to have these people rotate, even if it's 16-year term limits, at least it's something. And then that way you can get people that are really incentivized to actually do a good job. And so the biggest part of our spending today that would be almost impossible to cut, very unpopular at least to cut, would be Social Security, Medicare, and other social safety net programs. And I'm not saying, please don't hear me wrong, I'm not saying the government should cancel Social Security, which I'll get to in a second, because you have and I have contributed to Social Security as long as we've worked. It's your money. And companies have contributed too. So it's not this entitlement program that's just out of thin air. We have all contributed to this thing. And so it should exist. But I just want to point out the fact that Social Security, Medicare, and other social spending programs now cost $2.9 trillion of that annual budget, 47% of annual spending. And you saw this in Amity Schle's book, The Great Society. And you got to get that book, by the way. If you haven't read it yet, go get that book, The Great Society. And she highlights this phenomenon between guns and butter. And basically what she says is spending on defense as a portion of our annual budget has gone way down, and our spending on butter social programs has gone way up, and that's what we face today. We have spent way too much on social spending, and you can argue that we've spent too much on defense. I think a lot of us can agree that we don't want to be in endless wars, for example. We don't want to just be in endless problems all over the world and getting our hands into everything. A lot of people agree with that. So that can be a separate conversation. But something will have to change with social spending, or this thing isn't going to work. The system will break, and we will end up like Japan, which has an elderly population with a massive debt to GDP ratio, and it's almost impossible to get out of that mess. It's very, very tough. And so one of the easy things we can do, keep in mind, is when Social Security came into existence, the average life expectancy was only 63 years old. And so you were really only supposed to be on social for a couple years, tops, maybe 2-3 years at the end of your life. Well, now with people living longer into their 90s and their late 90s, I had one grandparent who lived till 85, one who was 95, one who was 94. You could be retired almost as long as you worked, and maybe longer sometimes. And so that's the problem. We are going to have to increase the retirement age at some point, or we're going to have to look at the benefits very closely. And I think that would be really sad to have to decrease Social Security benefits. And the reason why is because you paid in. Think about it like this, okay? Let's say, and just to keep it round numbers, let's say you put in Social Security 6.2%. That's just your half at $100,000. That's $6,200 per year. Now, remember, your employer has to match that. So any company out there, not only do they have to pay the salary, but they've got to match Social Security at 6.2%. Then they also have to pay 1.45%, and that's the Medicare tax. So just Social Security alone for a second, there is $6,200 on each side going in per year as long as that person works. Okay. And so if you go and you look at averages and you look at long run returns and all the rest of it, if you actually put about $12,000 a year into a portfolio in the market, you should end up with millions of dollars, anywhere from $2.5 to $3 million after 30, 40 years. And so at a 4% withdrawal rate, which is what we tell our clients they can do at 65 to be safe, you should be able to take over $100,000 out per year before tax at retirement if you were hypothetically putting away $12,000 a year for 40 years. Well, that is nowhere close to what you get with social. Social is a third of that actual number. And so that's, to me, the government mismanagement. That's government too big, having their hand in the pot, not knowing what they're doing, using Social Security for things other than Social Security. And so to me, it's stealing. What the government has done is they have stolen the wealth of millions of Americans, and the fact that they would even think about cutting Social Security is absolutely absurd. My question would be, where's the money? Show me the money. Where has it gone? The fact that millions of Americans have given this much money for this long to a system where there's nothing to show for it. There's almost nothing there at the end of the day. And so one of the proposals that's been out there for years now, I think Rick Edelman, who runs Edelman Financial, a very good firm, very, very great, reputable firm, they have been trying to lobby Congress to do something more like a Singapore approach. Some of these other countries, I think Luxembourg does this, where there's a corporate pension, a social pension, which is much better. And the way that would work is, instead of getting an annuity option at 65, where the government takes out all these taxes and adjusts down all these things, rather you'd have a lump sum available, kind of like a pension at your company. That would be a much better option for most Americans. But unfortunately, that would take a lot of political pressure, and I just don't see it happening anytime soon. So here's the bottom line. We are not in an abyss right now. It is not the end of the world. Do not panic. Don't let this debt downgrade scare you. We will get through this. But my warning is when you vote and when you go to the polls, just vote for your pocketbook. That's the best advice that I can give you, because if we don't get this under control and get it under control quickly, we are going to have problems. And I mean both sides of the aisle. They both spent a boatload of money. They've both been responsible for the problems that we have today. If we don't get it under control, we could have some serious long-term ramifications. Not ramifications in 5 years or even 6 or 7 years, but I'm talking for your kids, for your grandkids, and for the great-grandkids, the next generations who are going to have to pay off the spending of the past 3 years. What's the antidote to rising inflation, to the plummeting value of the dollar over time? Well, it's simply owning stocks. Remember, stocks, because they're that piece of paper that passes down input costs to consumers, will always have a propensity to beat inflation. They just will, unless there's a law enacted that companies can't raise their prices, which has been tried in communist countries and socialist countries. They try to do price controls and even wage controls. As long as we don't end up there, companies will beat inflation over the long run. Don't panic. Don't run for the hills. Don't go out and put all your stocks into money market thinking that that's going to save you. Ultimately, you're going to want to be in companies, but just make sure you're paying the right price, make sure you're in the right stuff, and you're buying quality. I think more than ever, what's going to happen is the best will have a massive separation from the rest. And I'm talking about the biggest and best, the top 50, 60 companies in the S&P. You're going to continue to see that gap widen over time. That's why management teams matter so much. That's why the competency of the CEO matters. That's why the balance sheet matters, the quality of the earnings. All these things start to matter. The days of just throwing it into a set it and forget it target date fund are over. That's my opinion. And you saw the investment and pension news report that came out that said target dates have been this absolute disaster for employees. That is absolutely true. It's been a mess. So if you are a person in target date funds, be very careful. Many of them have 20% in long-term bonds, which are down. The return, I just pulled the numbers for our Stenger Report quarterly newsletter. And if I look at the return on bonds now for the past 5 years, it's negative, just the nominal return. So not even including inflation, after inflation, real returns, bond returns for the past 5 years have produced negative results. That's pretty scary. That was supposed to be a safe place for clients. That's so-called what the safe place was with target date funds. It's not. And the other thing they've done is they've taken 30 to 40% of that portfolio in the target date, and they've done Europe, Japan, and Chinese stocks. Absolute disaster. And for the life of me, I just cannot understand advisors. I cannot understand model portfolios or these portfolio managers out there who think that, it's a good idea to sell U.S. companies to go into a place like China where they throw their most brilliant minds in prison. It just doesn't make any sense. So my opinion, stay with quality, stay in the U.S., stay with the best, and over time you will be fine. So that's all I've got for you this episode. We will see you next episode 124. Don't miss it. Don't miss Dr. Jeremy Siegel, September 7th. He is coming to us live in Oak Brook. You got to get it on the calendar. We'd love to see you there for a lunch, September 7th. And then we've got the big happy hour in Houston to celebrate our new office at Spring, right across from campus at the Marriott. All of our people are welcome, Exxon, Chevron, Shell, Honeywell, BP, whoever you are. If you're in Texas, come out September 20th. And then we do have the big investor day. That's our last event of the year, November 14th and 15th, downtown Naperville, Hotel Indigo. Don't miss it. Can't wait to see you there. Thanks for being on. We'll see you next time.